Whoever you are and why ever you're here, you're going to learn about the financial crisis of 2008. It is both a relatively historically interesting time in American history, as well as one that has severe financial repercussions for the markets that you'll be investing in and the financial and economic situation that you will walk into as you become adults, get jobs, get 401ks, jobs, investments, start businesses, etc. Today we're going to cover the history of financial regulation in the United States, and then how those financial regulations were slowly eroded to create a scenario that was quite similar in outcome, but different in process than the 1929 stock market crash. The stock market didn't do too great in 1929 and triggered a global worldwide depression. The interesting thing, people were saying at the time, it was like a COVID style event. People were like, this is the death of capitalism. There was hordes of people that flooded into New York City and set up camps so that they protested capitalism, and one of the most failed movements in history called Occupy Wall Street. People thought the whole thing was going to crumble, but then there was this miraculous policy implementation, was both clever accounting and generally well-founded economic theory that was put into effect that kind of bailed out the entire economy, but it still has a reverberation into today. By the numbers, this is a good infographic. Employment was above 9% in 2018. The last time unemployment had been that high wasn't until the Great Depression, when it spiked into the 20s, but people hurt. Housing prices fell 31.8%. And if you bought your house in 2006, as I had a couple of friends that bought their homes in 2006, imagine that you own a home that you think is worth $100,000 and that you put $10,000 into, and you think that the price of your house is $100,000, but all of a sudden it becomes less than $70,000. Means that you own a home where you basically are $30,000 in equity. So if you were to sell it, you would not be able to pay back your mortgage. You took a $90,000 mortgage out, you could pay back now $70,000 of it. You'd still owe $20,000 and not own a house. Just to give you a sense of that. There was giant bailouts, but functionally what happens, and we'll get into this, is all of a sudden these banks and these financial institutions that have been around for a long, long period of time, all of a sudden just dropping left and right. They keep filing for bankruptcy, and people pretty much know what's going on, but the depth of this crisis isn't well known. If we're going to go into a recession sometime soon, it's probably going to be because something happens on Wall Street where some companies don't report some numbers that they should have reported, and it will be revealed that everyone should have reported those numbers. Really, the economy isn't doing so well, so everyone will pull out their money, the stock market will go down, and then over the course of the next months and years, the stock market will eventually go up. There was a point where people thought we were going to run out of money. We are going through an inflation crisis right now. Banks wouldn't lend anything in 2008. I bought a television, like a big HD TV, for $180. Like, it was 56 inches, latest technology. Best Buy was just dumping whatever they could for whatever money they could to try and stay afloat, and this went for companies across the country. It was a weird time. We'll get into these bailouts, but billions, if not trillions of dollars are spent during this period of time to keep things afloat. But know that with a weird quirk in how financial instruments work, a housing market completely explodes, and this takes away the ability for people to basically afford the homes that they're in. There is a point during this crisis where it is cheaper for people to just mail the banks their house keys. Just put it in an envelope, send it to the bank and say, foreclose on me. Go ahead, take away my home because I am so deeply in debt right now, and no matter what happens with my home, I won't be able to do it. People who lost their jobs because of this crisis and who had homes where they were deeply underwater, that it just all fell apart. How did it happen? So we need to go back all the way to the 1920s, or actually before then. Banks were banks. You put money into banks, and if you needed your money, you pull your money out of banks. Simple banking 101. You put your money in, you get your money out. All the rest. What happens to the money that you put into banks? What do banks do with it traditionally? Do they just guard it? They lend it out. That's how banking as a business works. They lend it out to other people, usually to buy homes or to start businesses or to afford those things they can't normally do. So debt, like anything, is a financial tool. Not using it when you need to use it is a problem. Overusing it when you shouldn't be using it, also major problem. we're going to get to the point where overusing debit and leveraging leads to a problem. So it used to be banking's a simple business. You make money as a bank because you take people's money, loan it out to people. People pay you back with a little bit of extra money. You keep the extra money, and then you let people take out their money as you will. But as the stock market comes into a thing, banks come up with this clever idea where they say, instead of lending out the money, let's put our money into risky investments, or let's lend out the money to people to invest in the stock market. So instead of a tangible, real asset, a business where you can foreclose on it and collect the value, let's lend out money on variable price assets that have such a range of price that's a little bit riskier. At some point during the 1920s, leverage starts accumulating so dramatically that all of a sudden the actual value of stocks is not based on their worth in a company, but based on the amount of money that people are dumping into it. And as soon as people get wise to it, the whole thing falls apart. But this has a ripple effect through the economy, because it means that imagine tomorrow you woke up and you're like, I would like to go to Wawa and get a breakfast sandwich. And then you go to Wawa, you get your breakfast sandwich, you go to check out, and all of a sudden the bank says, we're sorry, we can't pay that. It says that you have $1,000 in your bank account, but we actually can't let you use that in any way, shape, or form. There would be panic and chaos because nobody gets their breakfast sandwiches. 1920s, after that, there are a bunch of investigations, and they separate two things. They separate commercial banking with investment banking. Commercial banking accepts your money, you make loans off of it, they can issue credit cards, they can set up assistance to consumers and businesses. Investment banking is where you also, this is where it's interesting and somewhat risky for a company. Let's say a baseball facility that trains youth players, but you're taking it global, and you're going to train baseball players around the world. You've taken this idea, it's immensely successful, it's catapulting baseball into an international sport, and you need an investor. A bank will underwrite or give you a bunch of money to basically start a public offering so that people can buy and trade and sell in your stock. You get a bunch of money up front from the bank, and the bank takes ownership of the stock for right now, although you will get majority ownership of it all. But for a certain chunk of money that the bank gives you, that you have as cash, the bank will now take these securities and trade them and make money that way. But you will maintain a large share of them to maintain control of your company. But that's underwriting. They can start IPOs, seasonal offerings. They basically take the risk off people by giving cash and allowing them to invest. And so the bank will hold on to that risk for as long as they deem is it financially worthy, while other people get kind of cash up front to do the thing that they need to do. So it all fell apart during the Great Depression, the stock market crash. Two senators, Carter Glass and Henry Stiegel, put together a bill that Franklin D. Roosevelt encourages and then signs to create separate institutions. So you can put money into a bank and be sure that the bank's not going to do something risky or crazy with it, and your money isn't going to disappear overnight, which is what was happening during the Great Depression. And so this seemed like a pretty good idea. Commercial banks are no longer allowed to underwrite or deal in securities, stocks, bonds, commodities, options, anything. And 10%, this 10% standard is important. It's the 10, 10, and 10 rule. It's 10% of money has to be in a bank at a given time. They can't just lend out all of it. Only 10% of commercial banks' income can be invested in securities, and the other 10% has to do with interest rates, but I can't remember. But commercial banks could underwrite government-issued bonds, because the government's got to get paid. Everything's separate and everything is great. And then the 1990s come along and everybody wants a home. And so they start to change and lower these backs. They say the American dream is home ownership, and we need to stimulate home ownership boom. They are going to try and stop the things that caused the stock market crash. Lindsey Graham and Tom Leach and Senator Bailey, they create a bill. Basically, they say banks are telling us that they need commercial investment banking back together so that they can do this magical thing called a mortgage-backed security. And that is where all of you have mortgages, but the chance of one of you defaulting on that mortgage over the life of it is high. But if I pull everything together into a bond, if 90% of it is really, really good, it's never going to fail as a loan overall because everything will just get covered. Let's say
One of you is like exceptional assets, like you have millions of dollars of assets, right? Functional millionaire, and you have excellent credit history. You're AAA rated as an individual. That means that you're probably not going to default on your loan, and even if you do default on your loan, you could pay it off with your millions of dollars, or you could sell a yacht or whatever. I don't know. Regular consumers with high credit score and a good job are going to get that AA rating, and that's going to go all the way down to your triple B's and sometimes your triple C loans. These are junk loans. These are people that are going to default. The idea is by putting them all into a bond, let's say triple C cancels itself out and it lowers the overall value of the bond is still solid. Bond doesn't have risk because people are paying into it. As long as a certain percentage, let's say 10 to 20%, of those mortgages don't default all of a sudden overnight, which is absurd. That would never happen, says the banks. But the more and more they kept giving predatory loans and rolling them into mortgage-backed securities, the higher and the higher risk it came for real estate crisis.
This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. The modern ones are different. They're private, and they're made up of layers of tranches. The highest level AAA is getting paid first, the lowest rated B's getting paid last, taking on defaults first. Now, obviously, if you're buying B's, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these B's and double B's went from a little risky to dog. Where's the trash?
I'm behind you.
I'm talking rock bottom FICO scores. No income verification. Adjustable rates. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple B's are going to 0 too. And that, you're too close, is an opportunity.
Okay, you're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
You're completely sure of the math.
I'm sure of the math.
A's, 0. B's, 0. Double B's, 0. Triple B's, 0.
So the other component of this are credit default swaps and derivatives. Derivatives are based on the real thing. So let's say we have oranges, and the price of an orange on the market is $1. A derivative is a security instrument that says we think the price of oranges in June is going to be $1.50, or we think the prices of oranges in June is going to be 50 cents. And so it is basically a side wager that was originally developed to be an insurance instrument. Then people figured out they could do the same thing with stocks. So you can trade options right now, basically saying you can buy call options, which is the right to buy a stock at a particular level. Let's say the current price of Tesla is 170. Options expire, which means that they have a time limit to them. And that time limit, let's say, is, let's do June, which is a very short period of time. In June, you reserve the right to buy a stock at $170. It expires June 30. What happens if the stock price is $200? You make 30 bucks. You have the right to buy it at 70. You sell it for $200. You pay for this 100 shares, let's say you pay $5 per share. $200, you make $30 minus the $5 per share, you make $25 per share, times 100, you make a nice killing. What happens if the price of the stock goes down to 150? It was $5. You don't own the stock. You can trade, these are exchangeable, which means, so the word security means that you can basically trade them. They're a contract that you can trade, and the value of that trade, so let's say this line represents May 1, and the price of your option has gone up to $8 on May 1, and because the price of the stock is now $165. On May 1, is it more likely that the stock is going to go to above $170? Price of the stock when you buy the option is $160 per share. on the market. You say on June 30, it's going to be $170. On May 1, the price of the stock jumps to $165. Is it more likely that it goes to 170 or less likely? More likely. So the price of your option is now gone up, and you can trade it. If you had to buy this again, it would be $8. So people want to buy this from you for $8. So how much money, if you wanted to offload it, would you get per share? $3. So you would make times 100, $300. Because all option contracts are worth 100 shares. In fact, most options traders, they operate in this whole time value function of trading. So a stockbroker, like somebody who's actually buying and selling stocks, will hold on to these pretty much close to their expiration because they're insurance policies. Because what they don't want to do is overnight hold a bunch of shares that could be worth nothing the next day. So they might hold put option, which is the right to sell it.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now, this is the first synthetic CDO.
I love Selena Gomez. I bet you 50 million she wins. And I'll give you 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
Now, somebody else is going to want to make a bet on the outcome of their bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win. So I want a great payoff.
About 20-1.
Deal.
And this will go on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
Sectors. Apple's under pressure. Yahoo down 8.5%. Cisco 6.5%. Research in Motion 10%.
It was the worst day on Wall Street since the crash of 1987.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
The bankers made irresponsible loans to homeowners, permitted them to buy property on margin. Then the housing prices collapsed, the mortgages couldn't be paid, and the banks essentially became insolvent.
The collapse of Bear Stearns was catastrophic. It was a wake-up call to Wall Street. That was a real tell in the unfolding and the house of cards coming crumbling down.
Fannie Mae and Freddie Mac are so large and so interwoven in our financial system that a failure of either of them would cause great turmoil in the financial markets.
The seizure of Fannie Mae and Freddie Mac as home prices started to fall set off a chain of events that made housing effectively freeze.
It is definitely a very, very difficult time, and it's not going to get better quickly.
Meanwhile, Merrill Lynch, fearing it could be next, agreed in an act of desperation to a shotgun marriage with Bank of America.
When Lehman Brothers got in trouble, the thinking was just let it fail. That was an enormous shock to the system. Others were in trouble as well. One by one, we learned that major financial institutions, some of the largest lenders in America, had made bad loans, bundled them into securities that were virtually worthless, insured them with companies that couldn't stand behind the insurance, and in the end, the federal government had bailed them out because we need these big banks to keep the economy going.
That's going to bring us to quantitative easing. You're a bank, you don't have any cash, and all you are holding are dog poop mortgage-backed securities. Literal trash. Garbage that is worth about 10% of what you originally valued them for. You cannot trade them. They are toxic. Nobody will take them, so you can't even sell them for the 10% that you originally had to raise cash to loan out and make more money. So you are broke. Banks won't buy it. Nobody will trade it. You can't get cash. And so the Federal Reserve came up with a solution called quantitative easing, and that is, I, Federal Reserve, am going to buy all of your garbage. All of the garbage on the market, I'm gonna give you full price for it. Full market price based on right before the collapse. So it's still a little bit of a deal for the government, but you get a chunk of cash that you can immediately do whatever you want with it. This is, we've heard the term bailout before. This is the bailout. But it's not quite just the government giving you money. It is, I also get these assets. The concept behind this is a very sophisticated one. It's not just giving money. The Federal Reserve now has something in return. And the plan is that you're going to get the economy back up and running again, and those assets that you gave me are actually going to go back up in price. Remember, at any point, bank can force a sale of a home and collect the total value of it. So if the bank is betting and it's going to say like, look, we're going to kind of slow roll these foreclosures, we're going to let people get back up on their feet, they'll eventually repay us, we'll come up with a plan where if they don't, over a longer period of time, we will sell the home. Eventually, those mortgages will bring back the full value that they would have gotten over time. And then, once housing prices have gone up, then we will sell those back out to the open market, and then we will take the money that we gave banks, and then we will destroy it. The idea being not to inflate the economy. Imagine this, right? All of a sudden, you had $100, now you have nothing. Now I'm going to generate and give out $100. Now, if I sold them back, and collected that money and then put that out into the economy, there's $200 where there was $100.